When you look out over the city skyline, with its gleaming towers and bustling streets, it's easy to imagine that the economy is powered by the visible hustle and bustle, by the people hurrying to work, the shops opening their doors, and the constant movement of goods and services. But beneath this surface, there's a hidden force quietly driving the entire machine, a force that most people rarely think about, yet it's absolutely crucial to the way our modern world functions. Today, we're going to peel back the curtain and reveal what's really keeping the gears of our economy turning, and why this invisible engine might not last forever. You might think it's innovation, or hard work, or even government policy that's the true backbone of our economic system. And while all those things matter, there's something else at play, a force that's both powerful and precarious. Right now, some of the world's largest companies are borrowing money at unprecedented levels. They're taking out loans, issuing bonds, and leveraging their future in ways that would have seemed unthinkable just a few decades ago. This isn't just a trend. It's a tidal wave of corporate debt, and it's reshaping the financial landscape in ways that affect every single one of us, whether we realize it or not. Let's break it down. When companies borrow money, they're essentially betting on their own future success. They use that borrowed cash to expand operations, invest in new technologies, hire more workers, and sometimes even buy back their own stock to boost share prices. This borrowing creates a ripple effect throughout the economy. Banks and investors who lend the money earn interest, which they can then spend or reinvest elsewhere. Employees benefit from new jobs and higher wages. Consumers get access to better products and services. On the surface, it seems like a win-win situation, a virtuous cycle of growth and prosperity, but here's the catch. All of this growth is built on a foundation that's far less stable than it appears. Imagine building a house on stilts over shifting sand. As long as the weather is calm and the ground doesn't move, everything seems fine. But if a storm rolls in, or the sand starts to erode, the entire structure is suddenly at risk. That's exactly what's happening with our debt-fueled economy. As long as interest rates stay low and companies can keep up with their payments, the system works. But if anything changes, if borrowing costs rise, or if companies start to struggle with their debts, the consequences could be severe and far-reaching. Let's talk about interest rates for a moment. Interest rates are like the price tag on borrowing money. When they're low, it's cheap for companies to take out loans and issue bonds. But when rates start to climb, those same debts become much more expensive to service. Suddenly, companies that were thriving on easy money find themselves squeezed by higher payments. They might have to cut back on hiring, delay new projects, or even lay off workers. In the worst cases, they could default on their loans, triggering a chain reaction that ripples through the entire financial system. And it's not just companies that feel the pain. Ordinary people can be affected too, through job losses, reduced investment returns, and even falling home values. We've seen what can happen when debt gets out of control. Think back to the 2008 financial crisis, when a mountain of risky mortgages and complex financial products brought the global economy to its knees. Millions of people lost their jobs, their homes, and their savings. While today's corporate debt isn't exactly the same as the subprime mortgage mess, the underlying risk is similar. Too much borrowing, too much reliance on cheap money, and not enough attention paid to what happens if the music stops. If companies can't pay their bills, or if investors lose confidence, we could see big trouble. Fast, the effects could be swift and brutal, with stock markets plunging, credit drying up, and businesses failing left and right. That's why some analysts have started calling this situation a ticking time bomb. It's not just a catchy phrase, it's a warning. The sheer scale of corporate debt today is unprecedented. According to recent data, global corporate debt has soared to over $90 trillion, a figure that dwarfs the size of many national economies. And much of this debt is concentrated in sectors that are especially vulnerable to economic shocks, like real estate, energy, and technology. If something goes wrong, if there's a sudden spike in interest rates, a major recession, or a geopolitical crisis, the fallout could be catastrophic. It's a risk that keeps central bankers, policymakers, and investors up at night. So what can you do as an individual in the face of such massive and complex risks? The first step is awareness. Understanding how the economy really works, and how much of it depends on debt, can help you make smarter decisions about your own finances. Stay informed about what's happening in the markets. Pay attention to news about interest rates, inflation, and corporate earnings. These aren't just abstract numbers, they have real-world consequences for your job, your investments, and your future. The more you know, the better prepared you'll be to navigate whatever comes next. It's also important to take a close look at your own financial situation. Are you carrying too much debt? Are you prepared for a sudden change in interest rates or a downturn in the job market? Now is the time to review your budget. pay down high-interest loans, and build up an emergency fund. If you're investing, make sure your portfolio is diversified and not overly exposed to risky sectors. Remember, the same forces that can destabilize giant corporations can also impact individual households. By taking proactive steps now, you can protect yourself and your family from the worst effects of an economic shock. The bottom line is this: our economy is running on debt, and while that can fuel growth and prosperity in the short term, it also creates significant risks that can't be ignored. The more we rely on borrowing to keep things moving, the more vulnerable we become to shocks and surprises. But knowledge is your best defense. By staying informed, making smart financial choices, and preparing for the unexpected, you can weather whatever storms may come. The future is uncertain, but with the right information and a proactive mindset, you can take control of your financial destiny. If you found this breakdown helpful and want to stay ahead of the curve with more sharp insights into the forces shaping our world, tap that subscribe button now. Don't miss out on the knowledge you need to protect your future and make smarter decisions, because in a world built on debt, information is power.